This webinar will be focusing on Surety Bonding 101. Please allow me to introduce Carol Henry to welcome in the presentation and introduce our guest speaker today.
Carol. Thank you, Johanna. Good afternoon. Thank you again for joining us today. My name is Carol Henry, and I am the program manager for the Contractor Technical Assistance Program. The CTAP program is just one of the programs that Meriwether and Williams Insurance Services administers throughout the state of California and beyond. Our programs are designed to assist small, local, women-owned, and disadvantaged businesses in public works construction. For more information about our programs, please visit our website at www.imwis.com. Please allow me to introduce Andrea Mapp, the presenter of today's bonding webinar. Andrea Mapp is a surety underwriting specialist with Liberty Mutual Insurance Company. With 15 plus years of experience, Andrea is a seasoned contract underwriter. Her analytical skills and sharp attention to detail have enabled her to provide contractors with the surety solutions that align with their needs. Andrea is dedicated to building relationships with her agents, contractors, and colleagues. She has a reputation as a trusted advisor and a go-to resource in the surety industry. When Andrea is not busy analyzing financial statements, you might find her hiking with her family or cooking a new vegan recipe. So without further ado, I pass it on to you, Andrea Mapp.
Thank you, Carol, for that lovely introduction. As Carol mentioned, my name is Andrea. I'm a surety underwriting specialist at Liberty Mutual Insurance. And I just want to welcome everyone and really thank you for taking the time out of your day to join us. You know, I'm excited about the opportunity to share this information with everyone. It's not every day that me as an underwriter get a chance to talk to a group of contractors or just a larger audience in general about the basics of surety bonds, and also like a little bit about, you know, what I do as a surety. So if you signed up for this webinar, then more than likely you have some questions about surety bonds, right? You might be asking, like, what exactly is a surety bond? Why do I need to set up a bonding program? Why does the surety company need so much information? And, you know, why does this underwriter keep asking so many questions? So after our discussion today, I really hope you leave with just a better understanding of what a surety bond is, the parties involved in the bond and the bonding process, what's needed from you, the contractor, to establish a bond program with Liberty Mutual. And also, I hope you get just a better understanding of the underwriter's perspective. I will be stopping kind of throughout my presentation and kind of checking in just to see if there are any questions. And Johanna will also be monitoring the chat. So I just really encourage you to send your questions to the chat. I hope this is more of a interactive conversation and not just me talking the whole time. So without further ado, let's just kind of jump right in. Johanna, you can go to the next slide. Okay, so what is a surety bond? Like that's pretty basic question. A surety bond is a three-party legal agreement where one party guarantees that a second party will perform or fulfill their obligations to a third party. So before we kind of break down that definition, I want to talk about the three players involved in the surety bond. So first, I want to talk a little bit about the obligee. And the obligee is really just a fancy way of saying owner, or like the GC for a project. They will be the entity requesting the bonds. So if you're, let's just say, bidding to a city or a county, and they're requiring or requesting you to provide like a bid bond or performance and payment bond, then that city or that county would be the obligee on the bond. And if you're a GC on if you're a sub on a project and a GC asks you to provide bonds, then that GC will become the obligee on those bonds. So another important thing to remember that, and you can see this clearly on our little surety triangle, that the obligee is connected to the principal through a contract or an agreement. They're also connected to the surety through the surety bond. So next I want to kind of talk about another party involved in the surety bond, and that's the principal. And the principal is the contractor. They're the company that's responsible for performing the work that's stated in that contract. And the principal is tied to the obligee, again, through an agreement. They're tied to the surety through an indemnity agreement. And we'll kind of discuss the indemnity agreement a little bit later. But for now, just know that an indemnity agreement, it's an agreement between the surety company and the principal only. So the third party or player involved in the surety bond is the surety itself. And that's the insurance company. That's going to be the company issuing the bond. And the surety is, again, connected to the obligee through the surety bond, and they're also tied to the principal through that indemnity agreement. So let's just kind of go back to our definition again. And, what is a surety bond? So after knowing the three parties involved, basically a surety bond is a legal promise made by the surety to the obligee to be held liable for any failures of the contractor. So for the obligee, a surety bond is really a form of insurance or like a risk management tool. That obligee wants to know that they won't take like a financial hit or a financial loss if the contractor doesn't fulfill their obligations stated in the contract. So I've talked a lot about, the agreement and the surety bonds, but I also want to just mention that if a contractor doesn't fulfill their obligations stated in the contract, then the obligee can declare the principal to be in default, and they can file a claim against the bond. So once a claim is filed against the bond, then the surety company that made that guarantee, they made that promise, they are obligated to compensate the obligee or go through a process of finding another contractor that will complete the job. So you heard me mention like a contract or an agreement. So I just want to take a second to kind of talk about the importance of a contract before we move on and go a little bit further. Because the contract it governs the surety bonds. The contract or the agreement, it will clearly state all the obligations of the contractor. It's going to state all the obligations of the obligee, and then it's also going to state the obligations of the surety company. So it's really important for a contractor to review all the terms of that contract. They want to make sure they have a good understanding of like what they're agreeing to. If they're not clear or something doesn't seem right, ask questions. If possible, it's even best to try to negotiate unfavorable terms. And a lot of contractors feel that that's something that they can't do, but it actually is, and it never hurts to at least just ask the question. So surety companies, just so you know, will also request a complete copy of that contract. And we're going to review the contract as well, just to make sure we have a good sense of what we're guaranteeing. But we also look for, unfavorable language within the contract. We're going to be looking for things like bond forfeiture language. We're going to be looking for consequential damages, liquidated damages. We're going to look at the length of the maintenance terms. Are they long? Are they extended terms? We're going to be checking the turnaround time for a contractor to respond or remedy a situation after an obligee has given them notice. We also look for completion days and completion terms. Do they seem adequate given the size of the project? So I know we kind of covered a lot of information. So again, I just want to check Johanna before we move on to the next subject, make sure there are no questions.
Hi, Andrea. So there is a question. It's, must I have a bond to do business?
That's a really good question. And short answer is simply yes. In the state of California, a contractor is required to have an active contractor's license. And in order to have an active contractor's license, a contractor's license bond is required, right, to keep your license active. So yes, you are required to have a contractor's license bond in order to do business. And hopefully that answered the question.
That did, thank you. And another question came up. If my business has more than one location, are separate bonds required for each address?
Again, very, very good question. Short answer, no. As long as that it's still the same company, it's still the same company operating businesses, and they maybe just have different, I don't know, office locations, then you're not going to be required to have like multiple contractor license bonds.
Okay, sounds great. Thank you.
Okay, so if there are no other questions, Johanna, we can move on to the next slide. Okay, so we're going to talk about just some common bonds, and these common bonds are going to be broken up into two kind of general categories, We have contract bonds, and then we also have commercial bonds. So I want to first just look at the contract surety bonds, because those are the bonds that contractors are going to run into the most. And probably the most common is a bid bond. So in order to even bid on some projects, the obligee, which again is the owner, will require that a contractor, provide a bid bond. And a bid bond basically guarantees that after a bid takes place and the principal is awarded the job, that principal will enter into an agreement with the obligee and provide the necessary documents. And those documents could be like a signed agreement. They will be performance and payment bonds, insurance, and other kind of certifications or certificates. So if the principal or the contractor can't provide those items, then the obligee can file a claim against the bid bond. And as I mentioned earlier, this is a form of like risk shifting for the obligee. If the low bidder provides a bid bond, but then they don't enter into an agreement with the obligee for whatever reason, the obligee will be protected, and they will not take a financial hit when they have to now award the contract to the second bidder at a higher cost. Bid bonds are also a way for an obligee to kind of pre-qualify contractors. An obligee knows that a surety company is not going to issue a bid bond for a principal that they don't think could do the job, right? There's also something called, there's also like another way for an obligee to pre-qualify contractors, and that's by requiring, a pre-qualification letter, sometimes called a surety bond letter. And this basically is a letter issued by the surety company, and it confirms, number one, that a contractor is bondable, but it also includes information like a contractor's program limits, and sometimes it will also include like a contractor's bond rate. So that's kind of in a nutshell, that's a bid bond. Again, it's a protection for the obligee, and it also is a way to kind of pre-qualify a contractor. And then there's also the pre-qualification letter or a surety bond letter that can be used to pre-qualify a contractor. So next, I kind of want to move on and discuss, again, these are the bonds that I see kind of the most, performance and payment bonds. So what is a performance and payment bond, and what do they guarantee? So let's first discuss a performance bond. A performance bond is a guarantee that a contractor will perform all the obligations kind of stated in the contract. And the surety company is guaranteeing basically the contractor will complete a project. This again provides a form of financial protection for the owner. If the contractor doesn't finish the job, then the obligee can file a claim against the bond. So what is a payment bond? A payment bond is guaranteeing that certain subs and suppliers will be paid for any labor or material that they provide for a project. So if a sub or a supplier doesn't receive payment for work done or materials supplied for a project, then then a claim can be filed against the payment bond. I did want to kind of mention as well that typically performance and payment bonds are issued together. And most contracts will state that a contractor must provide, a performance and payment bond to begin working on a project. So again, it'll all be stated in your contract, but most of the time, both bonds will be required. There are some cases where the contract will only require one or the other, and that's fine. Again, it really kind of just depends on what's stated in the contract. But I've seen some of our contractors that have done maybe some like Caltrans emergency work, and depending on the size of that contract, only a payment bond was needed. I've also seen recently some GCs only require performance bonds for larger contracts. So it kind of really just depends on that obligee or that owner and what's stated in the contract. So like moving on, just like another type of common contractor bond, contract surety bond is the maintenance and warranty bonds. And these kind of terms are used interchangeably, but they mean the same thing. And this is another form of protection for the owner. So this bond is going to guarantee that after a project has been completed and accepted, the principal will come back to either repair certain items or replace any like material defects found within a certain period of time. So the work also has to be repaired or replaced at no cost to the owner. It's really the principal or the contractor that's kind of footing the bill. So a standard like maintenance and like warranty period is typically 1 to 2 years. And again, this information will be clearly stated in the contract, but it's also normal for some contractors, depending on like the trade of work that they do, to have have longer warranty periods. So for example, it's pretty typical for us to see roofing contractors have like 3 to 5 year warranty terms in their contracts. And again, since a claim can still be filed against this type of bond, if a contractor does not come back to like repair or replace certain items, surety companies generally like to see shorter warranty periods. Another thing to just mention that warranty bonds can be requested from an obligee up front at the beginning of the project, similar to when the performance and payment bonds are issued, or it can be requested towards the end of a project as it's closing out. So the last two bonds that I just want to quickly mention are supply bonds and subdivision bonds. So supply bonds guarantee that a supplier who will end up being the principal on the bond, but that they will provide specific supplies and materials for a project. The bond also typically guarantees that these specific supplies and materials will be delivered on time. This bond protects like the purchaser of these supplies or materials. And it's still a 3-party agreement, but most of the time, the obligee is the person requesting the bond. And that can either be a project owner, a GC, or another contractor. But remember, whoever's purchasing the bond wants some form of protection, so they would require a supply bond. So the last contract surety bond that I want to quickly discuss is a subdivision bond. And these bonds are typically only for developers. When a developer is purchasing land and they plan to like subdivide that property into smaller parcels to like build a single family home, the local government will require the developer to provide subdivision bonds. And these bonds typically guarantee that certain improvements will be installed by the developer at no cost to the obligee or that local government requiring the bonds. So some types of subdivision improvements that could be required to be installed are street, sidewalk, curb, gutter, sewer, water main improvements, and also landscaping improvements. the specific improvements that need to be installed would basically be stated in the contract. So, and that was kind of the most common contract surety bonds. And I know that was a lot of information. So I just wanted to check in if you had any specific questions about any of these contract bonds. Now would definitely be the time to submit your question. And Johanna, if there isn't any, then we can just jump to the next slide.
Hi, Andrea. There are two questions.
Okay.
So the first one is, are surety bonds refundable?
That's a good question. And most of the time, surety bonds are not refundable. Once a surety bond has been issued to the owner, our obligation is out there. Our obligation as the surety is out there. So for the most part, there's not too many situations where we would provide like a refund on that premium once our obligation has been issued. And unless like for some reason a contract is 100% canceled and the work hasn't even started, more than likely we wouldn't like issue a refund for a bond.
Okay, thank you. The second question is, if I receive a bond for a contract that was $500,000 and the obligee asked me to perform another $500K worth of work in a change order, do I need to purchase another bond to cover the allegee's risk?
Okay, sorry. Can you read that one more time for me?
Okay.
I just want to make sure I have an understanding of the numbers in the question being asked.
Right. So if I receive a bond for a contract that was $500,000 and the obligee asked me to perform another $500,000 worth of work in a change order, do I need to purchase another bond to cover the allegee's risk?
Got it. So the contractor is basically asking if they have a contract for $500,000, they're doing the work. All of a sudden, a change order is issued for an additional $500,000 in work. Do they need to purchase another bond? And the answer is no. At that point, once you have an approved change order, the contract, your total contract amount has been increased. And at that time, once the contract amount is increased, your bond amount is increased as well. And again, that's why I kind of mentioned in the beginning, that's most of the time that's clearly spelled out in the contract, and that contract again governs the surety bond. So as your contract amount is increased, also the bond amount is increased, and you don't have to come back and purchase a new bond. But at the end of the project, once you're kind of closing the project out, we would ask for that final amount, and we would bill premium based on that new total contract amount.
Thank you.
Mm-hmm.
There are no other questions right now.
Okay.
Thanks.
Sure. So we can go to the next slide and jump into the commercial bonds. Okay, so commercial bonds, I will just say up front that I am not an expert in this area. There is a pretty big range of commercial bonds that guarantee different things. They can be guaranteeing a specific performance. They can guarantee that a principal will fulfill a certain obligation or guarantee that a certain payment is made. There really are just a ton of different commercial bonds. So instead of going through all of those, which I, again, am not an expert in that area, I want to just jump right to the most common commercial bonds for contractors. And that's going to be license and permit bonds. These bonds are typically required from the federal, state, or local government. And the first commercial bond that I'm sure every contractor on this call is familiar with is a contractor's license bond. And I know someone kind of had a question about this earlier, but it is a requirement by the state of California that all contractors must provide a $25,000 contractor's license bond in order to maintain an active contractor's license. So the contractor's license bond, it really protects the consumer or the contractor's clients from any financial loss if there's like some sort of defective construction. So another type of pretty common commercial bond for contractors is, an excavation or a grading or a right-of-way like permit bond. And again, these are usually going to be required by a local government entity. And they're typically required for like excavation and grading bonds, they're typically required when a certain amount of earth or dirt is being moved. And for the right-of-way bonds, those typically come into play when construction work is being done or being performed on the public right-of-way. So maybe on a sidewalk or, a crosswalk is involved, something like that. And every local government, from the city to different cities, different counties, a town, they're going to have their own specific requirements as to when these permit bonds come into play. And also the amount can vary between the local governments as well. And those are just there's a ton of commercial bonds, but those are kind of the more two common ones for contractors. So, Johanna, we can move on to the next
slide. Andrea, so there's one question.
Okay.
So on contract bonds, how is the bond amount determined?
Good question. So the bond amount, again, is going to be stated in the contract. It's the contract, again, kind of controls the surety bond. It will be clearly stated whatever that total contract amount is. It will be kind of clearly stated in the contract, obviously. And then you might see some language that says something like, a bond should be issued for like 100% of the actual contract amount. So with those terms, that the bond amount will be the same as the contract amount.
Got it. Thank you. There's one more question that just popped up. Are bond percentage amounts paid up front or after project closeout?
So the bond premium is charged up front. But the premium is adjusted during closeout. So, and a few different ways that can happen. Sometimes, an owner will ask for a consent of surety to final payment. And at that point, we as the underwriters might ask the contractor to provide, a final contract amount or a final contract price. If there were any change orders, there might be a difference in price. And at that point, we would bill premium based on that final contract price.
Awesome. Thank you.
Sure. Okay, so before we move on further in the presentation, I just wanted to kind of take a moment and I guess humbly brag a little bit about Liberty Mutual, if you will allow me just a few seconds. Liberty Mutual is ranked #1 globally and also in the US based on 2022 data. So I'm saying this not to really brag about our ranking, but to let contractors know that when you partner with Liberty Mutual, we really try to provide that #1 world-class service. And I'm going to talk about this a little bit more in detail later, but there are certain programs that we offer and certain things that we can do that our competition they can't do or they are not doing. Johanna, you can go on to the next slide. So one of the things I really like most about working at Liberty Mutual is the fact that we can really work with contractors of all sizes. We get the opportunity to write bonds for smaller contractors that may just be starting out and have small bond needs. And then we work our way up all the way to our large national contractors that may need as it's stated here across the screen, a $1.2 billion. So I think something else that sets Liberty Mutual apart from our competition is the fact that we have underwriters that are specialized to work with contractors of a very specific size. We have a team of underwriters, which we call our core team, that handles contractors that need $1.2 billion bonds. So they work with our national contractors. And Johanna, you can go to the next slide. So we also have our Surety Plus team, and that's the team that I work on. And within that within our Surety Plus team, there are 4 programs that have dedicated underwriters for each of these programs. So I'm just going to kind of quickly review each of these programs and then discuss what's needed from you, the contractor, for those programs. So first we have our credit-based program, which we call our Express and Express Plus programs. Our Express program is a true credit-only program where no financials are needed. This program has a bond limit of $750,000. So what this means is that Liberty Mutual can issue up to $750,000 in surety bonds for contractors that qualify based on their business and personal credit. So for personal credit, 650 is typically our minimum allowed credit score. And on the business credit report side, we're not really looking for a specific score. We're really looking more at the items that are within those business credit reports. So when reviewing personal credit reports, again, we're looking for a score of 650 or higher. We're looking to see if there are any bankruptcies, liens, lawsuits, if any accounts are in collection, if there's any past due accounts and the amount of those past due accounts. We're checking to see if an individual is maxed out on their credit lines. And if any of these exist, then an underwriter may come back and have some follow-up questions so you get a better understanding of what's going on. So again, with this credit-based Express program, we're running credit. Again, credit only, no financials. We're running credit. We're looking for a 650 credit score of any of the company owners, but we also request that your spouse's information so that we can pull their credit as well. And we're kind of looking for this same information. So in addition to the credit report, the individual credit reports for the owners and their spouses, we typically pull 2 separate type of business reports. And the first is called a D&B, or a Dun Street report. And this really focuses on a contractor's payment trends and their payment history. And it also provides us, the underwriter, with a financial stress score. So the report, in addition to payment information, it will also show any liens, lawsuits, bankruptcies for the company. If these exist on the report, then it's a red flag for the underwriter, and so we're going to follow up with some questions. So that D&B report, it also confirms some kind of basic information. It let us know when the business started, the company size, the officers of the company, and it provides kind of very detailed, again, payment information. So the second business report that we pull is called a Westlaw report. And this can be thought of as a legal background check or a legal background search. And it's going to pull any, again, liens, lawsuits, bankruptcies, UCC filings for the company. And if these items appear on the report, then we're going to have some questions and kind of, again, get a better understanding of what's going on. In addition, for our credit-based programs, in addition to running credit, we will also check the Contractor State License Board website to verify that the contractor's license is active. We're going to check the California Secretary of State website to confirm that, the contractor's business name or their entity is in good standing. We do a Google search for a website and see what other information we can find out on the company and the owners. We also will check LinkedIn, and that's a great way for us to get an owner's resume or kind of look at their experience. So the next program that I want to talk about is our Express Plus program. And this is where Liberty Mutual can issue bonds for contractors up to $3 million. And in this program, we still rely on the credit reports and other information we find online. But at this level, we will start to ask for financial statements. So once we've issued up to $750,000 worth of bonds, we will come back to the contractor. You're not kicked out of the program, but we come back to the contractor if they need more bonds, and we're going to ask for financials. So what's unique about this Express Plus program, it's not only that we can go up to $3 million in this program, but those financial statements that we request, they don't have to be CPA prepared financial statements. They can still be like internal or in-house statements, but they just need to be prepared on an accrual or a percentage of completion basis. Unfortunately, there's not much we can do if those statements are cash statements. We really want to see them on an accrual or POC, percentage of completion basis. So next we have our standard, our small to middle market program. And at this level, we have accounts that have surety bond programs up to $25 million. And again, we have these limits, but if you hit the $25 million, we're not like kicking you out of the program. There's always kind of wiggle room within this small to middle market program. Now, all of our accounts at this level are more than likely providing CPA prepared financial statements. And depending on their bond needs, we can accept a CPA compilation statement. But the larger your bond program is, then we would definitely require a good quality CPA reviewed statement. The next program we have is our subdivision program. So this is a program that's specifically, again, for our developer accounts that need those subdivision bonds that we discussed earlier. And we really don't have like program limits for our subdivision program. We can write some like really large subdivision bonds under this program. And the last Surety Plus bonding program that I want to talk about, but definitely not the least, is our VISTA program. And our VISTA program has, again, a dedicated team of underwriters that use tools to help contractors with their bond needs. So this would be contract accounts that are not like our standard small to middle market accounts. There may be some tools involved with putting together these programs. And the tools could be a collateral. We could take collateral. We can introduce funds control, or the bonds could be written through the SBA program. And I did just want to mention that our VISTA program has recently increased their limits and now has the ability to offer programs up to $30 million using some of the tools that I just mentioned. Another thing I want to point out about Liberty Mutual, and I kind of mentioned this, is that we have options. So we try our best we want to write bonds for you, right? So we try our best to maybe if, let's just say I have a new contract account and they have a bond need, and after pulling those credit reports, the results aren't favorable, right? So let's say that there is an open tax lien. Well, under the small to middle market program, we're not really able to approve bonds because of the open tax lien, but I can reach out to the underwriters on the VISTA team, and I can see if this is if it's something that they can put together using tools. And this now, again, would all depends on the size of the tax lien. And let's just say if the contractor has set up a payment plan, but again, it could be an option. We want to help you and we want to write these bonds for you. So again, Liberty just has options.
So Andrea, there are a lot of questions that popped up.
Okay, I'm sure.
Go over them right now?
Yeah, let's go. Let's jump right into it.
Okay, so first is on contract bonds, how is the bond amount determined? Oh, I think we already did that. So how are premium pricings determined?
So again, the premium, and when I think of premium price, I'm thinking of the total premium. And that's really, the total premium is based on, I think I mentioned the actual the amount kind of stated in the contract. So if the bond amount is 100% of the total contract amount, then the premium will be based on that total like contract amount.
Okay. Right. Thank you. Next question is, how do contractors apply for bonds to Liberty Mutual?
That's a very, very good question. And this is where Meriwether and Williams comes into play. So let's just say you want to set up a surety bond program. And I encourage you, get your bond program set up way before you need surety bonds, way before a bid. And there's a hard deadline, right, where you need to provide a bid bond. So this is when you would reach out to Carol Henry or Jennifer Elmore and then say, hey, I want to set up a bond program with Liberty. And, I work very closely with both of them, and they will, and I'll discuss it in more details, but they'll let you know exactly what you need to set up a bond program. And we'll also go over it in the next slides.
Awesome. Thank you. Next question is, why does the surety need so much information?
Of course. So as I mentioned earlier, the surety company, we're guaranteeing that a contractor will fulfill their obligations on a bond, right? So we ask for a lot of information because we want to feel good about what we're guaranteeing. We want to make sure that the contractor, you have the, in some cases, like especially for programs, over 750,000, we want to make sure you have, the financial capabilities to perform a job of that size. We want to make sure the owner has the experience, the company has the experience. So we're requesting a lot of information, and it might seem that way up front, but we want to feel comfortable and comfortable about what we're guaranteeing for the contractor. And once that program, we have the program established, I feel like it's not as bad. As long as we get the updates we need, there may not be a ton of questions like there are in the beginning.
Okay, thank you. Next question is, how does the surety handle multi-year contractors?
So that's a good question as well. We do have some contractors that do a lot of multi-year service agreements. I will say if you are a contractor that has this multi-year agreement, more than likely we're going to need financials. Since those multi-year contracts, they span across multiple years. Again, we want to make sure as a surety that you have you're financially stable and you have enough financial strength to perform all the obligations of the contract over the years.
Awesome. Thank you. Next question is, how long does it take to request a bond request and get a bond issued?
Good question. Later on, we will kind of go over the specifics that are needed for a bond request. But again, I want to mention the first step is really before there is a need and a deadline for a bond, reach out to Carol, Carol Henry, or reach out to Jennifer and get your program established before there is a need. And so that way, when you do have a bid bond or you need a performance and payment bond, the process will be smoother because we already have your information. We can be good to go.
Okay. The last question is, how do surety determines the rates for each contractor?
Good question. It's hard to put this one in general terms. I will say for the kind of most part for that express program where it's credit based only, up to $750,000. Our normal bond rate is 3%. That is pretty standard, and there's kind of not much wiggle room in that. But as you kind of move up in your program and we're obtaining more information, we have your financials, we've, all of our questions have been answered. At that point, it's kind of on an individual case by case basis, but there is a possibility for that rate to be reduced based on experience and financial strength.
Wonderful. Thank you.
Yep. Okay. So now that we've kind of touched on that, yeah, I was going to say we can jump on to the next slide. And this is kind of what's needed to establish a bond program within our credit-based program. So I think someone kind of had the question of like, what exactly is needed? You know, number one, reach out to Carol or Jennifer. But I'm going to kind of break down exactly what we're looking for and why we need specific information. So let's start with that Express program, which offers bonds up to $750,000 without financials. So the first thing we're going to need is an application or a questionnaire. And this is a 5-page PDF fillable document that provides underwriters like myself with all the basic information about the company. It's going to give us, you know, the company name, the entity type, your tax ID number, your address, your license number. It'll list all the owners, their spouse's information, their address, social security number, date of birth, so we can run credit reports. So that is a very important document. If you're within the Express program, it's a 5-page document, the application, but some of the pages you don't have to fill out. And it's clearly stated on the application which pages you should or shouldn't fill out. One thing I did want to mention for all of our programs, I wanted to talk a little bit more about the indemnity agreement. So on the last page of this application for our Express program, there is a 1-page indemnity agreement. And this will need to be signed by the owner or the president of the company on behalf of the company, but it also will need to be signed by all owners who own 10% or more of the company, plus their spouses. And if any of the owners or their spouses have any assets held in a trust, then the trust will also need to be added to this general indemnity agreement as well. So you might be saying, okay, so it looks like, you know, the company, the president has to sign for the company, the president has to sign individually, their spouse has to sign individually. What is this general indemnity agreement? And we call it GIA for short, but a GIA is an agreement between the principal and the surety company. And this agreement basically states that the principal will reimburse the surety company for any financial losses that the surety incurred for issuing a bond on behalf of a contractor. So like I mentioned, when a bond is issued to an obligee, the surety company is guaranteeing that a contractor will complete that job according to the terms of the agreement. If the principal doesn't complete the job and a claim is filed against the bond, the surety company is obligated to either cut a check to the obligee for any of the uncompleted work, or they have to hire another contractor to finish up the job at their own expense. So this indemnity agreement protects the surety company from any financial loss. If a surety company has to pay for a bond claim or they have to pay for another contractor to finish up a job, then the surety company will come back to the principal and will ask to be reimbursed. So if a company, you know, the principal, the contractor can't reimburse the surety company, then we will look to those individual owners who signed the indemnity agreement to be reimbursed. So just again, this means that owners of the company and their spouse, and possibly if a trust is involved, they can be required to make the surety company whole again if the surety company has a loss on their behalf. So this is pretty standard in the industry. And some companies, I shouldn't say some, surety companies will not issue a bond for a contractor until we have this agreement signed. So again, let's kind of jump back into the discussion of what's needed for the Express program, but I just wanted to take some time to kind of discuss the importance of the indemnity agreement. So after we have that application, we have pulled personal and business credit reports, and everything comes back favorably, then we should be able to confirm that a contractor has a bonding program up to our express limits of $750,000. However, I do want to say that most times after reviewing all the information, the underwriter may have some follow-up questions or need some additional information. So for our larger credit-based program, our Express Plus program, we will need a little bit more information, right? We are offering a larger size program up to $3 million. So our risk increased with the increased size of program. So we will need a fully completed application. Again, that will provide the underwriter with that basic information, but at this level, it also provides things like the largest jobs completed to date, so we can do reference checks on those larger jobs. It also tells a little bit more about your internal financial systems, which again is important to us because financials will be provided. We're going to specifically request your last fiscal year end statement and also a work in progress statement. And this, again, these can all be internal statements depending on the size of your program. Also, depending on the size of your program, we may need a current interim statement. So typically, most contractors have a 12/31 fiscal year end. And let's just say at this point, we're almost in October. If a contractor comes to me with a larger bond request, then most of the time I'm going to ask, since it's been 9 months since the last financials, I might ask for a current interim statement and also a current WIP schedule or work in progress schedule. We also would look for your accounts receivable and accounts payable aging schedules. And with that information, we're basically checking to see if there are any like slow receivables over 90 days. If so, we might kind of request an explanation or possibly ask if there's any issues with that job. So another thing we might need is bank statements. And we ask for bank statements to verify the cash amount stated on your financial statements. This is only a requirement for accounts that provide internal statements. We will also ask for personal financial statements of all owners. Again, we're looking to confirm the financial strength of an owner. And, in some cases, the financial strength of the owner helps build up the surety program. So just like with our Express program, we will need that one-page indemnity agreement executed as well. So again, after reviewing all the information, after reviewing the credit reports, analyzing the financial statements, we might have some follow-up questions or need some additional information in order to establish the bond program. So for some of our larger bond programs, small to middle bonding program, or VISTA program, or subdivision programs, we pretty much need most of the information that we just discussed. So it will be the completed application. Again, that's going to provide us with some of that basic information. We will need the last fiscal year end statement and WIP schedule. Now, internal statements may still be accepted at this level, depending on the size of your surety bond program. But again, depending on the size of your surety program, we may really start to push for CPA prepared statements. And as an underwriter, when I'm reviewing those financial statements, I'm really looking at, number one, the quality of the statement, how reliable are these internal numbers that I'm getting if it's an internal statement. I'm looking at your cash position. I'm looking at the amount of your accounts receivables, your accounts payables. I'm looking if there are any shareholder loans or shareholder receivables, things like employee advances, those kind of things. I'm really analyzing the entire statement. I'm seeing, did you have a loss at the end of the year according to your income statement? So it's really, we do a very thorough financial analysis. And again, we're gonna, depending on the size of the program, we may need to ask for interim statements. We're gonna ask for those accounts receivable, accounts payable schedules. Bank statements would only be required for contractors that are still providing internal statements at this level. It wouldn't be a requirement if you provide CPA prepared statements. So again, we would need personal financial statements of all owners. let me see. So that is pretty much it. And the reason why we kind of ask for all these financial documents, we're trying to basically determine what size program we can offer, based on a contractor's analyzed net worth and working capital. And I think it's mentioned here, I mentioned it earlier, we will still need like an indemnity agreement for all of our bond programs. However, at this level with programs of this size, so we're talking over the $3 million program, we require an indemnity agreement, but it's no longer a one-pager. At this level, we have full-length indemnity agreements that need to be executed. And typically, again, at this level, the indemnity agreement can be 7 to 10 pages long. And it's still an agreement stating that the principal will reimburse the surety company for any financial loss, but it's just in much greater detail. So again, after reviewing all this information, we may have follow-up questions in order to establish the bond program. So I'm going to pause because I feel like that was a lot of information related to items needed for a contractor. Johanna, I just want to check in and see if there are any questions.
There are a few, so I'll read them out right now. So one is, so can you talk a little about the differences between bonds and insurance?
I will try to do my best. I will say that they are very different. A surety bond is, again, it's a guarantee. It's issued for every project, and it's kind of a guarantee that a contractor is going to perform the obligations stated in their, in the contract for that specific job. An insurance, with insurance, contractors have like a general liability insurance, or they have like auto liability insurance, and those are policies, that are not typically related to the performance of the contract, if that makes sense. So those are protecting. Those policies might, the general liability policy might protect the contractor, and really the surety bond is a guarantee or a form of protection for the obligee of a project or the owner of a project. Hopefully that helps.
Okay, I have an audience that raised his hand. I'll allow him to speak, to ask the question, I guess.
Okay.
Hi, Eduardo. You're on mute.
Hi, can you hear me?
Yes.
Well, thank you for letting me speak. Andrea, you're doing a great job. I am enjoying your presentation.
Oh, good.
I think you know who I am. I've worked with your firm many times.
Okay.
What I wanted to say is, as you know, I do a lot of these workshops, and I'm asked the same question. Why is bonding so difficult? Why do I have to have bonding? I have a licensed bond, et cetera, et cetera. And I think it would be helpful for the attendees for you to emphasize a couple of points. Number one, the reason that bonds are so different from insurance is because it's not insurance, and it's much cheaper. That bond premium that you talk about, the 3%, that is a one-time charge only per contract. And you don't have to buy bonds if you're not doing bonded work. So one of the things I tell them in doing their estimate is you add the cost of the bond premium into your bid, and that takes care of the bond. Now, if you do qualify for bonding, maybe you could tell them what they're going to get. They're going to get two levels. They're going to get a per project cap, and they're going to get a total bonded volume cap. And again, back to the issue about the 3%, the reason that it's so cheap is that, as you pointed out, the indemnity agreement, which I think many bonding companies don't emphasize enough, when it says keep the surety whole, it's not a maybe. It as you know, Andrea, it is absolute. I mean, our company, our family company, everything we own is pledged to the bonding company. So we're banking, and they are banking that we're not going to go broke.
Correct.
So it's really important that the newer contractors understand this.
Yes, thank you so much, Ed, for those comments. And yes, you are correct. When I approve any bond, I am approving it feeling confident that a contractor is going to complete the job. I'm not approving it like, I don't know. No, when I say it is approved, I'm confident that the contractor can do the job and complete the job. So yes, we are banking on the contractor completing the work of that project. All the details stated in the contract.
Awesome, thank you. That should be it for now. Thank you.
Okay.
Thank you.
So we kind of left off on, the items needed for a contractor to set up a bond program, but let's move to the next slide and we can talk a bit about what an underwriter looks for when we're reviewing a bond request. So I first want to, again, point out that it's very important to have your surety bond program kind of set up in place before you have a surety bond need. Sometimes the process of setting up a bonding program can take a few days, especially if, I have additional questions or I need you to obtain additional information. So you definitely don't want to be, kind of pressed and you have a tight deadline, let's just say a bid bond, a very specific deadline, and you think, the same day we can get everything worked out. And we might be able to, but then there is a chance that we can't get everything set up that quickly. So I just really encourage you, again, reach out to Meriwether and Williams early on and get your bond program set up way before you actually need the bond. So let's talk a little bit about what I review, after a surety program has already been established and now a contractor has an actual bond need. So the first thing I'm going to ask for is a bond request form. And then again, this is providing me, the underwriter, with basic details about each project. It's going to let me know if this is a bid bond or if this is a final bond, like a performance and payment bond need. I'm going to, on that bid bond request, it's going to provide the completion days, the warranty period that we discussed, who's the owner, are there any liquidated damages? So just some of the, again, the basics. I might ask for, I shouldn't say that. I will also need the bond forms. The owner usually has very specific bond forms they want to use, even if it's a bid bond, performance bond, payment bond, whatever it is. Owners typically have very specific forms that they want to use. So I will need to review those bond forms to review the language and confirm that the terms are acceptable for the surety. I will also, and I'm sure you guys heard me say this plenty of times, I need the contract. The contract is such an important piece of the surety bond. So I need to review that contract and make sure there's no unfavorable language or terms. Bid specs, that's another thing it just provides so much more details about the project. Sometimes, we'll get a bond request form, and I know contractors are busy, you guys are busy, but I will, they will put incorrect warranty periods or incorrect liquidated damages. So if I get a copy of all the bid specs, I go through them as well and then just kind of confirm some of the information. Depending on the size of the request and also, again, the time of year, I may need updated financials. And I think I kind of mentioned this. If the last financials, if I got a bond request in today and it was a sizable bond request for a contractor, and the last financials I have in my file are 12/31/2022, and here we are almost in October, again, I may ask for more current financials. So again, after reviewing all this information, I could possibly have follow-up questions or request additional information. And That is, Johanna, we can go to the next slide. So that is pretty much all the information that I have to share with you guys. Again, I know we discussed a lot of different information. We talked about what a surety bond is. We talked about all the players involved, what's needed to set up a bond program, what an underwriter, some of the things we look at when we receive that specific information. So I just hope you kind of leave here with just, again, a better understanding of surety bonds and kind of what's needed from you. But I know we still have some time to answer any questions. So now would be a good time. Either submit your questions through the chat or you can raise your hand as well.
Andrea, there's one question. Do full length indemnity agreements require notarization?
Good, very good question. I like that one. So for our express programs, those programs that are credit-based, where there's that one-page indemnity agreement, we do not require notarization. We can actually execute that two ways. We can send that application to you, and you can sign it and email us a PDF copy back. So that works. We don't even need originals. Or we can submit a DocuSign request for those one-pagers. For the larger programs, again, since we are offering larger size programs and we're taking on a larger risk, those longer agreements need to be notarized. And we also request originals be returned back to us.
Great, thank you. Another question is, can you talk a little bit about the claims process?
Sure. I'm not a surety claims expert. I will say that, so I'll try to do my best. Liberty Mutual has a whole separate team of claims professionals made up of, claims attorneys, paralegals, and, really, that's their area of expertise. But I will definitely say just a little bit in general about the process. We typically first get notified of a claim. We, as the underwriters, we get notified of a claim or a potential claim from your agent or, from the contractor themselves. They kind of know there's some trouble on the job, they're having issues, and you might get that feeling that this is kind of where things are headed. It's heading into a claim situation. So you, the contractor, will reach out to your agent and your agent will reach out to us. It's really important, we prefer, if you can, just let us know. The earlier, the better. There's usually some sort of legal consequences and legal deadlines. So the earlier we know, the better. Even if it's not a potential claim, but there is the threat of a claim, reach out to us. Let us know what's going on. Also, at that point, once I know that there's a potential claim, I contact my claims team right away and they jump right in. What they're trying to do is mitigate the issue as soon as possible, right? And there has been times where they're able to, jump in there and intervene early enough, bring all the parties to the table and help, again, remedy the situation so there isn't an actual bond claim filed. So we want, once I get a notice, I immediately involve our claims team so they can kind of jump on it and kind of get the ball rolling. They sometimes reach out to the contractors directly and say, hey, what's going on? They might reach out to whoever the potential claimant is as well to get, their side of the story. But again, there's legal deadlines, so we want to make sure we start the process as early as possible.
Right, thank you. So the next question is there a limit on bonds that a contractor can receive?
Yes, but it depends on two things. For Liberty Mutual's Express program, again, that's the credit-based program only. The limit is $750,000. So, that is the limit. There are some contractors I have that they live within that program, right? We might issue a few bonds that together total that $750,000, and they won't need any more bonds until they work and close out some of those projects. So that has that credit-based only program does have a hard limit. For our programs outside of that express $750,000 limit, your surety program really depends on, the other factors that I mentioned. It's going to depend on the information stated in credit reports. It's going to depend on your financial strength. It's going to depend on the experience of the owners, and the experience of the company. So in those situations, after you reach that $750,000 amount, the limit is basically the bonding program limit is on a case-by-case basis.
Great, thank you. Another question is, where can we get a bond request form to get our program started? Thank you.
Yes, good question. That again, I'm going to refer you to Carol Henry and Jennifer Elmore. Like, you want to reach out to them, reach out to Meriwether and Williams and say that you're interested with establishing a bond program with Liberty Mutual. And they know how to get in contact with me.
Nice, thank you. Another question is, what is the best way to keep your surety company updated so they are prepared whenever you have a bond request?
That's a good one. So make sure you send us current financial information as soon as it becomes available. You don't want to wait to the point till there's a bond need and we're requesting it. As I mentioned, most contractors have a 12/31 fiscal year end. So, we've received a lot of our contractors at this point, their 12/31 fiscal year end information. But, we also like to see a 6/30 statement. So, and again, we might need a statement in between that time, between December and January, just depending on the size of your program. But as soon as your interim 6/30 statements become available, send it to your agent and they'll send it directly to us. So it's just keeping your financial file up to date. Once you have a program established, credit reports are run annually. That's something that's done automatically in our system. So we keep that information updated. And again, like on an annual basis, we like to see a current personal financial statement. So you can send us that information just to keep your file current, even if there isn't a specific bond need.
Great. Last question. Do the full-length indemnity agreements require notarization?
Yes, they do. They have to be notarized, and the originals need to be returned to Liberty Mutual Insurance.
Awesome. So I want to thank everyone for coming today, and I want to thank Andrea Mapp for sharing your expertise with us. That would be the end of our webinar.